The moment of truth for Trump's trade war has finally arrived. Will he hold firm? Will cave again? The whole world will be watching, but Wall Street has already placed its bets. Chicken or trade warrior? What should you do with your money right now? Donald Trump's 90-day pause on his reciprocal tariffs is set to expire on July 9th. Wall Street does not seem too concerned. The consensus is that either Trump, having blinked already once, will blink again, or that he will lower his sights and start closing deals between now and the deadline. Polymarket is currently assigning a 70% chance that Trump will cancel the majority of reciprocal tariffs before the deadline. The betting market is even giving a 40% chance to a deal between the US and the European Union, arguably the most difficult deal to pull off by July 9th. The bond market is so relaxed about the threat of tariffs that inflation risk premium has virtually disappeared. 2-year US inflation break-evens are back down to levels last seen during Biden's final days in office. The stock market is even more nonchalant. Between Liberation Day and April 9th, when Trump called time out on the trade war, the US stock market fell sharply, with energy, technology, materials, and consumer discretionary particularly hard hit. Since then, the stock market has not only recouped all of these losses, but racked up further gains. Indeed, tech stocks are now 20% above their high before Liberation Day. Even the cyclically sensitive industrial sectors is now 8% higher, and the consumer discretionary sector 6% higher than their highs just before Liberation Day. The same can be said about the currency market. Between Liberation Day and April 9th, most major currencies, especially those vulnerable to a global slowdown, fell against the US dollar. Some very hard. Since April 9th, the dollar has weakened across the board. Except for the Turkish lira, all major currencies are now trading above their pre-Liberation Day levels against the US dollar, regardless their sensitivity to global trade. Trump's one-too-many capitulations in trade negotiations have convinced the market that he does not have the stomach to go through with his tariff threats. The million-dollar question is whether the market will be proved right on July 9th. Taco trades versus Donald Trump. Much is at stake. Beauty is in the eye of the beholder. In theory, current account deficit countries have less to lose than current account surplus countries in a trade war. In theory, given the massive US current account deficit, the dollar should strengthen in a trade war. The fact that the dollar has been weakening since Trump launched his trade war is a clear sign that the market, rightly or wrongly, has decided that the US is losing the trade war. I suspect Trump disagrees with this assessment. I suspect, if anything, Trump thinks his trade war is going well, even very well. And what matters for what Trump will do on July 9th is how he thinks and not how the market thinks his trade war is going. Trump frequently talks about tariff revenue as a windfall for the US. Windfall or not, tariff revenue has been surging over the past 3 months. The US collected $22 billion in tariff revenue in May. Preliminary data suggests that the June number could be closer to $30 billion. $30 billion a month is $360 billion a year. That is more than 1% of GDP. A lot of money, no matter how you look at it. But who's paying the tariff? Americans or foreigners? It is too early to say for sure, but so far there's no evidence that the US consumers are holding the short end of the stick. The consumer price for goods excluding food and energy was unchanged in May. And the producer price for final demand goods excluding food and energy climbed only 0.2%. There are unconfirmed reports that US retailers like Walmart and Target are demanding their suppliers in China and Southeast Asia to absorb up to 66% of the cost of the tariffs. Whether this is true or not, US import prices from China are falling fast. And so are Chinese producer prices. It's too early to say who will ultimately foot the tariff bill. But from Trump's perspective, his trade war cannot be going any better. Government coffers are filling up, the stock market is rising, and inflation remains in check. Trump could well think that he holds the stronger hand on July 9th. It is now obvious to me that he will capitulate on July 9th. And if he does not, markets can find themselves in trouble. If Trump has a strong incentive to hang tough on July 9th, where do Americans' trading partners stand? It is telling that India and Japan, two countries that until recently seemed most eager to cut a deal with Trump, have not done so. It says a lot about the state of Trump's trade negotiations if even Japan and India have not capitulated to his demands. Let's start with Japan. Japanese Prime Minister Shigeru Ishiba and Trump failed to strike a deal at the G7 meeting last week. The sticking point was Trump's 25% auto tariff. With 8% of the Japanese workforce employed in the auto sector, for Japan to accept Trump's 25% auto tariff is to accept an economic disaster. It would amount to surrendering the core pillar of its industrial base, sacrificing millions of jobs, and undermining its future as a sovereign economic power. Ishiba, who's facing a tough upper house election next month, has little room for compromise. It is interesting that Ishiba canceled his attendance of the NATO summit this week. What about India? India is one of the most protectionist economies in the world, with the highest average tariff rate among the major economies. India Prime Minister Narendra Modi, who once ruled India uncontested, now has to rely on the support of coalition partners to stay in power. With 45% of India's working population employed in the agricultural sector, conceding to Trump's demand for lower import duty on genetically modified food could be a political suicide for Modi's Hindu nationalist BJP party. Farmers' protests cost the BJP its majority in elections in 2024. 6 weeks ago, it might have been easier for Modi to sell a deal with the US to his diverse constituencies. With US tariffs on Chinese imports of 145%, Modi could have argued that the price of a trade deal is a potential huge increase in India's share of US imports and US direct investments abroad. But with Trump having been forced to lower his reciprocal tariffs on China to just 10%, the upside for India in a trade deal with the US is much more limited. Meanwhile, Modi now has to contain the public anger at Trump's pronouncement that he was responsible for the ceasefire between India and Pakistan, and Trump's hosting of the head of Pakistan's army at the White House earlier this month. A trade deal between the US and India before July 9th could still happen, but the odds are not too great. Then there is, of course, the European Union. Trump has threatened to impose a 50% tariff on all EU goods on July 9th unless the two sides reach a deal. Most EU goods already face a 10% tariff, with levies up to 25% on cars and car parts and 50% on steel and aluminum. While the European Commission is reportedly under pressure from Germany and Italy to move quickly to close a deal with the US, the two sides appear still quite far apart. The EU wants exemptions from the base tariffs for selected products such as cars, pharmaceuticals, machinery, and steel and aluminum. But these are precisely the industries that Trump wants to revive in the US. Unlike Japan and India, the European Union is a major importer of US goods that last year amounted to $355 billion. This means the EU has more leverage in the negotiation with the US than other countries. It is difficult to see the EU accepting a deal along the line of the one-sided US-UK deal. EU wants to woo Trump by lowering some non-tariff barriers, buying more US liquid natural gas, and cooperating with the US on tackling economic concerns about China. But it is doubtful that Trump will see these concessions as a win. Wall Street sees Trump's tariff as a bargaining tool that will go away once their purpose has been achieved. I think this is wrong. Much of what Trump says makes me think that he sees tariffs as both the means and the end. Tariff revenue is needed right now to plug the fiscal hole. And Trump has said repeatedly that tariffs have to stay to entice foreign companies to produce in the US what they sell in the US. Tariffs is central to Trump's economic agenda. His capitulations at times may be tactical, but not the tariffs. His truce with China was necessitated by US dependency on Chinese rare earth. It is a mistake to view it as a blueprint for other negotiations. Ironically, Trump's truce with China makes it more difficult for other countries to accept deals that are less favorable. Because everyone wants to get the best deal. No one has an incentive to be the first to do a deal. I'm going to assume that Trump won't like the offers on the table on July 9th. He can give a further extension to the deadline, but this will almost certainly be seen as another capitulation that will not result in better offers. Trump doesn't have good options on July 9th. I don't think the market is sufficiently discounting the risk that he will carry out his threat to impose unilateral tariffs. This is the biggest risk for popular trades right now, like US stocks and EM currencies. I think a short position in S&P Consumer Discretionary provides a good hedge against this risk. Thank you for listening.